Okay, hi everybody. Well, I'm glad we weren't speaking yesterday when it was 100 degrees out here. And I'm glad that there's a little bit of shade, but thank you all for taking time out of your day to spend to learn a little bit about alternatives. And I have kind of the perfect person to talk about that and how advisors can utilize alternative investment strategies for their clients and make them accessible to their clients. So I'm going to get right into it because we only have 20 minutes and I have a lot of questions.
All right.
So Blackstone has been known as best in class for its institutional product offerings, but made a very smart play by entering the wealth management industry now almost 10 years ago. Within the last 5 years, Blackstone's retail AUM is up fivefold to, get this, $233 billion. So that's B with a that's a B, billion. Can you provide a little bit more on the backstory of what made your firm kind of decide to go into the wealth management space after really being that go-to source in the institutional space?
Sure. First, nice being with all of you and with Suzanne on stage. So at the time that we went public, which was 2007, we were managing 88 billion firm total, and less than 5% was on behalf of private wealth, and it was friends and family. And then, of course, as everyone knows, we hit the global financial crisis, and strategically we started thinking about diversifying sources for our funds. And we began looking at private wealth and ultimately determined that we would be better served by distributing and partnering with RIAs and the big wirehouses, et cetera, rather than trying to build our own, that what we're really good at is managing money. And so we really started just on the listening tour. And then initially we were distributing our global private equity funds, real estate funds, but those can only go to qualified purchasers.
Okay.
And so about 5.5 years ago, we began designing bespoke products. But the basic idea was take Blackstone institutional quality product and bring it to private wealth, same teams.
Wow. And so what has been the response from the advisor community, the RIA community, many of which are here, to the offerings? And how was it different than the offerings that were already in existence in the wealth solutions area?
So we've had great reception, I'd say, because everything that we're designing is built off of the backs of good performance at Blackstone. And so we're really just working with the current asset classes that we're in. But the game changer was the creation of the perpetual funds. So non-traded REIT, we looked at that market and the quality of the products that were out there, we thought were really subpar. And we just thought, I don't know, we're the biggest commercial real estate investors in the world. We can do better. So we created something that had lower fees where we don't take any acquisition disposition fees. It was always around, can we provide a good net performance? And then can we match it with excellent service education? Because something that I think was probably implied in your first question is most advisors today still aren't allocating to alternatives. So it's not just enough to show up with something.
Right.
Really, like, just share the intellectual capital, teach, what is private real estate, what is private equity, and how do those fit into a more traditional portfolio?
Right. And maybe part of the reason is that there's probably some misconceptions about what the minimum entry level point is, right? So what is that? Is it something that advisors can easily access, and how are they able to access your offerings?
Yeah, it's interesting. So to invest in private real estate, the minimum is $2,500. I would say the average is significantly greater than that. So the median investment's around $80,000. But you could go in at a much lower point. And because we're taking monthly subscriptions, what lots of folks do is they just continually allocate to it.
That's great. I did not even know that. So $2,500 gets you into
It does.
private real estate. Okay, well, take note of that. That's a good tweetable piece of content. So we've talked a little bit about institutional investors, and I'd love to understand from your perspective, what do you see as the biggest differences between what institutional investors want versus what retail advisors and their clients want and need? I know that a lot of times, a lot of advisors that I've spoken to really look to institutions to see what their philosophy is on investing, and apply it to their own business. So what are some of the top things that you've learned from that?
I mean, I think regardless of whether you're an institutional investor or an individual investor, you're going to be thinking about return, risk, and liquidity. So it doesn't really matter.
Okay.
But your needs will vary. Certain institutions, if you're a pension fund, you have to pay out a certain amount every year. So having that in terms of their cash flow income is important, all different dynamics. So I would say the top down from that perspective is similar. The other big difference is for the institutional investors, they absolutely have an allocation to private real estate, private credit, infrastructure, private equity, and today, depending on the type of institution, the alts portion of that is anywhere from 20 to more than 50%. So if you look at the big college endowments, they tend to have more than 50% in alternatives. Individuals today have less than 5% in alternatives. It's growing, but much more focused on stocks, bonds, and cash. I think that's changing a little bit. And I actually think the other difference is the perception. I do think that by and large, a lot of individuals and advisors were conflating liquidity with risk. And arguably, daily liquid, Russian equities or what have you, is not going to be less volatile than private real estate. And understanding that private real estate just means it's not publicly traded. 90% of all real estate in the world is actually private. 90% of all companies in the world are actually private. And so when you're thinking about the public markets, it's actually a pretty small part of the total investable pie.
It's interesting. I had no idea about that. And I actually have a follow-up question to something that you mentioned. Why do you think there is such a difference between the allocation to alternatives in the institutional space versus the allocation in the retail space? Is it misconception? Is it access to product? What are your thoughts on that?
I think, first of all, the regulatory limitations on, institutions can invest in anything.
Yeah.
There are no limits in how much type of fund, and they're managed by, professional portfolio manager allocators. When you move to the advisor community, you're limited in terms of your client base. So if your client is not a qualified purchaser, you can invest in the typical drawdown structures. And I would say until recently, you really didn't have great options, great quality options for accredited and below. And, I mentioned, I think the game changers have been perpetual products, number one, better technology. I mean, it's crazy that we're talking about this in these times, but something like e-signature that still doesn't exist in a lot of places where you have to have wet signature. I mean, that is just a limiting factor. And so, if you have 100 clients and you want to allocate an alternative B-REIT even or B-Cred, and you have to fill out a subdoc, it takes a lot of time. And so in addition to, as I mentioned, building the products, I think it's key that whoever you're working with has built out an equally scaled investor services team, education team with marketing materials and the like. It's not just about the fund. It's have you approached private wealth as a total business?
Yeah, that's such a great point. And that education piece, I think, is so critical. And there needs to be more of it, quite frankly, in my opinion, in this industry. So I want to talk a little bit about market conditions. So inflation, interest rates, supply chain issues, labor shortage. How does this all impact one of the core areas of your business, real estate investments. Obviously, you're a leader in this space. What are you seeing from your perspective? You mentioned you're the largest real estate investor in the world. I would think you would have a couple of bits of insight that may be interesting to our audience here today.
Yeah, sure. So I will say just generally, so we are the biggest real estate investors. We own more than 250 companies. We lend a lot of credits. We basically look at all of that data as this phenomenal dashboard, and we use that when we're looking out making investment decisions. Now, again, we're not looking at months or days. We're really investing for years, and so we're trying to see like where those trends are going. About 2 years ago, we started to see signs of inflation, and it was really twofold. You have certain structural shortages, and then you had disruptions, and then you had shifts in demand. So if you take an area like rental housing, for example, since the global financial crisis, you've had a shortage in terms of building of new homes versus new household formation that has persisted. But when you're in an environment like this, where the cost of building has gone up astronomically, you mentioned labor shortage, you can't even get enough people to finish the construction, and now interest rates are going up. It's just only exacerbated. And so we've never had a period, at least in the recent decades, where the gap between the cost of buying a home and renting a home was so wide, with the advantage going to renting. And because real estate is the kind of asset class where, buildings don't just pop up from the ground, you can actually see the supply coming. This is an area we're quite focused on. But really importantly, like, not all real estate's the same. And so our focus has been seeing inflation, short duration. So we wanted to be in real estate sectors where you can reprice your rents in the short term. Owning long-term real estate, that's like owning fixed income, not very interesting. So areas like data centers, logistics, especially those that are close to urban areas, multifamily housing, where, again, the government data was showing rents going up 4%, but we knew on the ground that rents were going up in the mid to high teens. And then it's not just the asset class, it's selection. So we're very focused on, in that particular case, in the US, South and West, where we saw population trends migrating. We use data science. We look at where jobs are happening and new jobs, wealth going up. And so, you read a lot about rent affordability, but in the areas that we're in, you had folks with higher income levels moving in. So the affordability index was actually better there than in the whole of the US, even though rents were going up 16, 17%.
That's fascinating. I would not have even thought that the rental market is really the area that is the most impacted by what's happening.
And I would say in our 30-year investment history, we have never seen stronger trends in that part of the market than we're seeing now.
So what does that do for interest rates? Do you feel like they're going to continue to increase? And do you ever, as a company like Blackstone, have influence over, giving some input into what you think should be happening on that level?
We have no influence over interest rates, and I am definitely not in the prediction business. So I am just taking the Fed at its word that they are going to continue to tighten. And I don't think you fight the Fed.
Got it. That's really, really interesting. So following up on kind of the questioning around the markets, how has the recent market volatility affected the way alternative investments are being utilized, both from the institutional side as well as from the private wealth side?
Yeah, so I would say just to separate the secular trends from the cyclical, which that is cyclical. On the secular side, what I mentioned before, which is more available product, easier to put into portfolios, more education. Those are all secular tailwinds that I think will continue to increase allocations to alts. But as all of you know, the start to the year, 60-40, 70-30, whatever it is, the worst start most of us have experienced in our entire investing careers.
Yep.
And that has, I think made folks look a little bit more at alternatives, and the conversations have accelerated, and we see it moving from something that's kind of a sideshow to something that's more core part of the allocation. And that is, I wouldn't say different, because those conversations were happening, but they're happening more pervasively today.
Yep. Yeah.
And just one other piece of it, which is, the prospect for rising interest rates, as an example, has to make you question your fixed income portfolio, or even when you think about inflation, what you're holding in cash. Both of those, are likely to devalue.
Yes.
In value. And so, thinking about floating rate credit, which should perform well, short duration, real estate, or assets where you have control and you can affect change. I think one of the other issues with public markets is they're subject to the whims of flows. And with private investing, first of all, you're using non-public information going in. You're signing non-disclosure agreements, and then you have the opportunity to actually improve that asset, hold it longer, divest of non-performing businesses, invest in growth, whatever it is that you're trying to do. It just gives you better control on the ultimate outcome.
Yeah, that's great. Those are great insights and a lot of food for thought from the alternative side of things. So I want to talk a little bit about the future, right? So we're at future proof. What is the future? What major trends should advisors and the wealth management industry at a whole be on the lookout for from your perspective?
And do you mean from an investing perspective?
From whatever you'd like.
Oh,
so it could
all
be
right.
investing or just in general, what are you seeing from your perspective, from your vantage point?
Okay. So first, I'm going to talk about it in two different ways. One is just what is Blackstone seeing across the portfolio. And we tend to do a lot of research up front, have a lot of conviction, and then we go all in trends. And we're very focused on long-term secular trends around life sciences. We see a lot more money going into biomedical research. E-commerce is a trend we've been focused on for 20 years. Sometimes I think people just get bored with the trend, like, oh, we know about that. It's still moving. So when you look at e-commerce penetration, that makes you want to not just invest in warehouses, as I talked about, but just the whole ecosystem. So it could be payments, cybersecurity, so all of the adjacencies around that. Digitization, again, of almost everything in technology. Now, in each of these areas, again, you want to be sensitive to price. It's not just buy at any price, but these are just long-term tailwinds. And then I would say from an investing perspective, as I mentioned, we're just seeing much better product, more accessibility, and more understanding of how these fit in. I'm just going to let that go.
This is one of the beauties of live events and being outside, and I happen to love.
Yeah, and I would just say the following. Probably 80% of advisors today still don't really allocate much in alternatives, and it can seem daunting. We'd be happy to spend as much time with you as you want. There's a lot of just resources on our website, online. Again, I'm not talking about a specific product, just how do the structures work? What is private real estate? What is private credit? What is private equity? Practice management and the like. And, we do a lot of educating through Blackstone universities, webinars, one-on-one meetings. So I would just encourage you to, do a little research. And again, I'm offering us up, but whoever it is that you're comfortable with, reach out, and we're happy to work with you and talk about what might make sense for your clients.
Yeah, I think that the approach that you guys are taking on the educational level is really critical, because that is not just for educating advisors, but for advisors to talk to their clients and explain why an allocation to alternatives makes sense based on their portfolio.
So I mean, we've had more than 11,000 advisors go through Blackstone University so far.
Amazing.
Yeah.
That's wonderful. Do they get a diploma?
They should.
Well, I want to just end this with asking you one last question, which I'm famous for asking. What is the one takeaway around alternative investments that you want to leave our audience with today?
Alternatives have to be part of any well-constructed core portfolio.
Okay. That's quick and to the point. And with that, we thank you guys so much for your attention today. Thanks for coming out. And Joan is here if you want to ask questions afterward. Thanks again.
Great. Thank you so much.